Ladies and gentlemen, good day and welcome to Cantabil Retail India Limited Q2 and H1 FY26 conference call. As a reminder, all participant lines will be in the listen mode and there will be an opportunity for you to ask questions after the presentation concludes. Before we begin, a brief disclaimer: the presentation which Cantabil Retail India Limited has uploaded on the stock exchange and their website, including the discussion during this call, contains or may contain certain forward-looking statements concerning Cantabil Retail India Limited business prospects and profitability, which are subject to several risks and uncertainties, and the actual result could materially differ from those in which forward-looking statements. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I now hand the call over to Mr. Vijay Bansal for opening remarks. Over to you, sir.
Good evening, everyone. On behalf of Cantabil Retail India Limited, I extend a warm welcome to all participants joining us for the Q2 and H1 FY26 earnings conference call. Joining me today are Mr. Deepak Bansal, Whole-Time Director, Mr. Basant Goyal, Whole-Time Director, Mr. Surendra Nigam, Chief Financial Officer, Ms. Poonam Chahal, Company Secretary, and our Investor Relations Advisor from Merchant Capital. We trust you have had the opportunity to review our Q2 and H1 FY26 results. The earnings presentation and financial statements are available on the stock exchange and the company website. Cantabil Retail India Limited commenced FY26 on a strong note, building on the momentum of landmark FY25. The company delivered healthy growth in revenue and profitability, supported by strong same-store sales growth, disciplined execution, and growing brand dominance across markets. This strong performance during H1 FY26 highlights the consistent execution of our strategic roadmap and reinforces our commitment to driving profitable, sustainable growth. The volume expansion demonstrates increasing consumer confidence. Increasingly, we are observing early signs of demand recovery in recent months, driven by government initiatives on GST rationalization and favorable monsoon conditions across most parts of the country. These factors, alongside upcoming wedding and winter season, are poised to strengthen both rural and urban consumption and further boost overall consumer sentiment. I now hand over the call to Mr. Surendra Nigam for giving updates on the financial performance of the quarter. Thank you.
Thank you, sir, and a warm welcome to everyone. Coming on the numbers, standalone performance highlights for H1 FY26. Revenue from operations for H1 FY26 grew by 20% to 335 crore as compared to 279 crore in H1 FY25. EBITDA for H1 FY26 grew by 23% to 91.1 crore as compared to 73.9 crore in H1 FY25. EBITDA margins for H1 FY26 stood at 27.2% as compared to 26.5% in H1 FY25. PAT for H1 FY26 grew by 19% to 21.4 crore as compared to 18 crore in H1 FY25. PAT margins for half year ended FY26 stood at 6.4% as compared to 6.4% in H1 FY25. Coming to the standalone performance highlights for Q2 FY26, our revenue from operations in Q2 grew by 16% to 176 crore as compared to 151 crore in Q2 FY25. EBITDA for Q2 FY26 grew by 22% to 42.1 crore as compared to 34.5 crore in Q2 FY25. EBITDA margins for Q2 stood at 23.9% as compared to 22.8% in Q2 FY25. PAT margins for Q2 FY26 grew by 3% to 6.8 crore as compared to 6.6 crore in Q2 FY25. Our PAT margins for quarter ended FY26 Q2 stood at 3.8% as compared to 4.3% in Q2 FY25. We will now begin the Q&A session and for open forum. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Arnav Sakuja from Ambit Capital. Please go ahead.
Hi. Thanks for taking my question. So if you look at average store size, it is around 1,350 square feet. And if we look at the stores that have been opened in the last year, correct me if I'm wrong, the size has been around 1,960 square feet. So is this a deliberate strategy that we're following to open larger stores?
So your voice is not clear. What I understood the question is, my current size is opening is 1,350 square feet as compared to 2 years back. It's a shorter format, right? That's the question. And what's the strategy behind it?
No, my question is more along the lines of in the last 1 year, the stores that we have opened, the average square feet is larger than that of the average square feet of our entire store network. So I just wanted to know, is there a deliberate strategy to open larger stores?
Okay.
Yeah, it's a deliberate strategy to open a larger store. Our earlier company average size was around 1,300 square feet. And now we are moving to the 1,600 square feet for the new stores which are coming. So we are doing the bigger stores because in the bigger stores, the EBITDA margins are better. We are getting better sales and we are getting a better display for our merchandise, and customer experience is also getting enhanced in the bigger stores. So in the smaller stores, we were underperforming, and in the bigger stores, we are getting the optimal performance for the company.
And these bigger stores that are being opened over the last 1 year, are these more of male, female, kids, or a mixture of all of these?
These are mixture of all. So we have family stores, we have men's and ladies stores, we have only men's stores. So these are the mixture of all. And in only exclusive men's store also we have increased the size a little bit. And definitely family stores are definitely bigger, but in men's and ladies stores also the size is going bigger.
Okay, thank you for answering my question.
Thank you.
Thank you. The next question is from the line of Arjun Gaikwad, who is an individual investor. Please go ahead.
Hello. Thank you for the opportunity. I wanted to understand that whether the company has any specific strategies or initiatives in place to further improve the PAT margins going forward, so that it can drive a stronger EPS growth. If so, could you please share what kind of margin improvement the management is targeting over the next few years?
So on an annualized basis, we are always working to increase our margin on EBITDA level as well as PAT margin. So this year also, last year we closed approximately 10.5%. This year, very much hopeful, we are crossing 11%. It may somewhere in between 11 to 12%. And going forward also, this continuously improvement in PAT margin you will be able to see. The reason is mainly this: the more I will getting the same store sales growth, the mostly the expenses are fixed. So left hand side of me, my P&L is always being saved. So the moment I'll get more sales, more top line would have been there, which we are projecting going forward this year onwards. So our PAT margins would definitely increase.
Okay, sir. Thank you so much.
Thanks, sir.
Thank you. A reminder to all the participants that you may press star and one to ask a question. Participants are requested to press star and one to ask a question. The next question is from the line of Mr. Arpan Rathore from Insight Advisory. Please go ahead.
Good evening, sir. Congratulations on a decent revenue growth. Have a couple of questions. Though the revenue growth for the quarter has been 16%, even with a little shift in festive season, I see PAT margins not going up proportionately. Any specific reason, or how should we, budget in for the full year types?
Right. So there are two main reasons for comparison. Number one, this quarter we have opened approximately 29 stores, right? So the moment we open that store, it will take some time to get all full revenue. However, overall story is that even in the 3 months or 1 month, they are on a break-even level. So there is proportionately on a percentage basis that is being reducing. Number two, my Ind AS adjustment, that is Ind AS 116 adjustment, is increasing. In last quarter YOY, my Ind AS impact for the quarter was 1.2 CR, and this quarter it is 2.1 CR. Because we have opened more stores, the larger stores would have been there, so obviously rental cost is increasing. The moment I'll have a more rental cost, my Ind AS expenses, Ind AS 116, will be increasing. So these are the two main reasons. Pre-Ind AS numbers, if you have seen in our presentation as well, on a H1 basis, apart against 20 CR tax H1 last year, this year we have grown up to 20% to 25 CR.
Okay. Taking this question further, and with all the new store addition plans which you have, how much revenue number we should budget in for the current fiscal year and FY27?
So, the last year we closed at a 721 CR, and we are very much on track for the 20% growth. So this year it should cost 850 plus CR, and by this pace, next year financial year, by FY20 year, we are crossing 1,000 crore of the revenue mark. That is our vision statement as well. And on this basis, all my PAT margins that I just told, replying the previous question, it would be approximately 11 to 12% for this financial year. It is going further 12 to 13% next financial year.
Okay, so 850 means 515 or 20 odd crores in the balance 2 quarters. Isn't it too high ask, or we are confident there?
No, that's the confidence, because we have everything on our track as well. My H1 is approximately 38-39% of my overall revenue. Because the winter come, festival seasons come, my ticket size is significantly increasing. So these are the absolute number on track. 850 plus is on track.
Okay. And just if you can highlight the impact of GST rationalization which has come in. Are we seeing any green shot there? Or how is the company working on those things?
So GST impact, yes. 22nd of the September is a landmark date. We are completely passing it on the benefit to the consumer. The differential of 7%, because most of our, as you know, our average selling price is approximately 1150. So between from 1,000 rupees to 2,500 rupees, my sale is accumulated approximately 60% on annual basis. For this, we are completely passing the benefit to the customer. We are passing this benefit to the customer, but we have seen the momentum. By passing this, honestly, the benefit to the customer, momentum is there. GST rationalization benefit is going forward will be giving because the footfall are increasing.
So then how was October? If you can just indicate in terms of revenue built up, considering the value was also there.
Very good double-digit growth in October as well, we registered.
Okay. And store addition target for the full year? It's at 630 now, so we should close the year by 650 or 660 types or more than that?
We will close near 675 stores.
675. And of the additions which we are planning, they would generally be the larger size stores, right?
So our new average size store we are opening is around 1625. So same we are projecting for the next 2 quarters.
So, considering that this is a strategic move, are we also looking to relook at the old stores or to increase their size or something of that sort, or this is only for the new stores which we will add?
We are increasing the size of the old stores also, but only in the special cases, not of all the stores. Wherever there is expiry is coming or where there we see a potential where by increasing the size of the store, the sales can be increased in a much better manner. Only in those stores we are increasing the sizes.
Sure. If I may ask one or two more questions.
Yeah.
I have seen the company is very conservative when it comes to borrowings. But September, I can see there's some borrowing built up which has happened. So, was it more to do with the seasonal impact, or are we going the borrowing way?
So, we are a zero debt company for last 4-5 years. September, if you have seen, there is another investment is also there. So 22 CR is the net borrowing. So that is not the borrowing. We are utilizing some working capital limit for the September season pile up of the inventory for the winter. So in the month of September, hardly some utilization of the working capital is there. Overall, it's a debt free going forward also.
Yeah, so strategically we will maintain the net zero debt position on a longer basis, right? Few quarters here and there should be fine.
Couple of months in a year, we are utilizing the limits.
Sure. Yeah, that's it from my side. I'll join back the queue for more questions.
Thank you. Thank you, sir.
Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Chandragupta, who is an individual investor. Please go ahead.
Hello, am I audible?
Yes, sir.
Yeah, okay. Sir, I just have one question. See, when you are looking for a location to open a new store, what are the things you look for in that location? And also, what are the things you avoid? Do you have some such checklist or whatever you may call it? How do you identify a location that is nice?
So first, there are 2 financial criteria that we should be able to get minimum 1 CR of a sale in a year. And second is it should be a profit-making store and not a loss-making store. Second criteria for hunting these kind of locations where we get these type of numbers is that location should be in the heart of the market. It should have a good parking facility. Approach should be good. It should not be a narrow road. The market should have a future where other brands can also hunt for location and open their stores when they plan to come in that particular city. It should have a good frontage. We generally go for a frontage bigger than 15 feet. The landlord should provide a good space for the signage. And these locations are generally in the tier 1, 2 or in the district headquarters. We are not going in the tehsil level towns, sub-tehsil towns. So these are the no-go areas. The old concept of retail where there is a huge rush of the people but there is no parking space available. So these kind of places we are avoiding.
Okay, but malls you are avoiding, is it? Or you are opening in malls also?
Malls, our presence is less. We have around 10% of the stores in the malls. So we are majorly high street based brand.
Okay. And if there are many similar stores, competing stores around, then is that a plus point or a minus point? How do you look at it?
So presence of other retail brands, we consider it as a positive point. We don't consider it as a negative point.
Okay, that's all from my side. Thanks, sir. Thanks a lot.
Thank you, sir.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Arpan Rathod from Insight Advisory. Please go ahead.
Thank you for taking my questions back. Just have few operational details which I wanted. One is how much was the contribution or in terms of revenue from our online sales?
So, overall contribution from the online sale, there is actually a change in the billing method for the two major clients. So I'm handing over the call to Mr. Basant Goel, who is heading a whole-time director heading our e-commerce.
Sure.
Yeah, basically, so there's a change in the e-commerce space in terms of the billing that the e-commerce platforms does. So earlier they used to give, the revenue used to be booked with the sale value including the freight cost. But now the major e-commerce companies, they have separated the freight cost into a separate company. So that is not booked in the revenue right now. So that is why in terms of revenue, the e-commerce sales in terms of quantity, the e-commerce sales have grown by 20% in the first half. But in terms of value, if you see that the growth can only be seen at 8%.
So that would be one time, 1 year impact. Otherwise, next year onwards, it should be comparable, right?
Yes. Next year, you will see the growth will be more comparable to this year because the structure would remain the same.
Okay. Secondly, in terms of the capacity, I see a capacity of 2 lakh square feet, which can produce 1.8 million garments as per your presentation. Now that expansion track has been there and we are, budgeted for another 50-60 stores expansion this year and next year onwards. Do we see any capacity expansion happening, or we will rely more on the job workers?
So yes, total sale, as you said, our overall production requirement, 60% is fulfilled by own manufacturing through our factory, Badugar factory, which has a capacity of 18 lakh piece, as well as job workers. Job workers like own production. So 60% we are feeding from our production and 40% is FOB. So, however, there is no plan to further extend in our own factory and job work is going to increase. So additional capacity would come from the job work mainly and FOB. But broadly, the ratio would be 60-40.
60-40. But this will come down, right? Because now that we are planning to reach 1,000 crores of turnover in FY27, that's your vision statement. But the capacity will remain the same, right? Production capacity.
Let me clarify one more time.
Sure.
I have my production capacity. So there are two ways of production: own production as well as knit what we are procuring from Ludhiana. Own production is 60%. That has two parts. One is my factory, which has been able to, a specialized suit plant, which has been able to produce 18 lakhs of the garment and balance through job workers. Job workers like our job workers, we are getting the stretching charges, rest controls is ours. So yes, no more factory is in the planning immediately. So job work proportion would be increasing. But overall on the requirement basis, 60% and 40% broadly would be same.
So those job workers are dedicated job workers on our roll, or how is it? Dedicated job workers, right?
Big dedicated units, yeah.
Sure. And if you can just share the number of designers you may have, because ultimately everything is how good you design, right? In fast fashion world, the designing capabilities are something which is of paramount importance. So, is there a number which you can share?
So we have 5 designers. So they are handling different categories. Like men's, ladies, kids are 3 categories, and men's also there are the subcategories. So these 5 designers are taking care of the designing section.
Sure. That's it from my side. Thank you.
A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Aditya Iyer from Mode Foods. Please go ahead.
Hello, sir. Am I audible?
Yes, sir. Yeah, you are audible.
Yeah. Good evening. Thank you for the opportunity, sir. I just have one basic question. One of the basic questions that I just wanted to know, what is the type of loan of the working capital that you mentioned? Is it some term loan or a credit facility or something?
You are having a loan borrowing, right?
Yeah, the borrowing. Correct.
So we have a zero borrowing company for last 4-5 years till that from the court. So we have a zero debt company. Long-term borrowing has never been in the company, even before 2022. We are only having a working capital limits in the bank, which we are hardly utilizing in couple of months. Overall basis, we are a debt-free company and cash surplus company. If you have seen in the last balance sheet also, we have a 32 around surplus fund. This year on the balance sheet, it would be more than that.
Okay. And another question, that in the September 22 and 23 quarter, the net profit margin was comparatively higher than 24 and 25. So any specific reason for that?
You are talking about FY22-23 versus FY25-26, right?
September quarter 22, September quarter 23, and September quarter 24 and September quarter 25.
Sir, I need to revisit the number, obviously. But overall, on an absolute basis, in terms of percentage, because we are opening up more stores now, it is slightly the most lean quarter for the industry as well. So maybe couple of percentage would have been there because India's impact is also there and now increasing. Earlier it was hardly 50-60 lakhs for the quarter. Now it is 2.1 CR for the quarter. So that number. However, for the quarter-wise FY22-23, I'll revisit and give you a specific answer. We can connect it separately.
Right. So one last question. Can I get a brief overview on how is the lease liability treated in accounting terms?
Yes, sir. So, India's 116 is, every time we have out of 630 stores, 80% of stores are on a lease basis, right? Now we are having a lease rentals to be paid. Last year, my approximate lease liability was 80 CR plus. So what India says is, since you have all the control over the property, the long-term lease of 9 year, 12 year or 15 year, so this is like an asset you have been created. So you need to capitalize those on the basis of present value, and at the same time you need to create a lease liability. So once the new property is to be taken, it's a similar. One side of balance sheet is a lease liability, and other side is the right to use assets. So now this is just a presentational difference. Broadly, you need to convert rentals. We are in the business of rent. We are paying rentals, but you will be able to see there is no rental cost is there. This has been converted into depreciation as well as finance cost. We have a zero finance cost because we are debt free, but still finance cost is showing and depreciation is showing on a very higher side. So 80 crore of broadly, just giving the broad ballpark number, 80 crore of the rentals have been converted last year into the depreciation as well as finance cost. So that is why theoretically you have seen my EBITDA is showing 10% higher from the normal pre-Ind AS EBITDA. This is what the broad concept of Ind AS 116.
Thank you so much, sir. That answers all my questions. Thank you.
Yes, sir.
Thank you. The next question is from the line of Srijanan Mittal from MS Capital. Please go ahead.
Hi, and thank you for the opportunity and congratulations on a good set of numbers. So I have two questions. One is, Shivendra, can you help me with the number of company-owned stores that we have as on this quarter? First is that first.
Opened?
Just as on date, the number of COCO stores that we have. I think I have the number for last quarter, which is 475 as of June 25. So as of September 25, what would that number be?
So we have opened out of 25 net stores. One store was franchisee being opened, and the balance is being company-owned stores.
Understood. The second question was on the depreciation side. This depreciation number, would it include the capitalization for the new warehouse as well as the new office space which we have built?
Not yet, because we are once it will be capitalized, we are moving in the month of January. That is when we shift. Then it would be capitalized. Still, that is a part of CWIP.
Understood. Right. Okay. Got it. Just one more question, if I can squeeze in. So, if on a new category that we had started earlier was footwear, right? How has the trajectory been on the footwear side? How has that progressed?
Your footwear side is going stable. So last year we did well. This year also we are targeting good numbers that it should end up with 30 CR of sales in a year.
Understood. No, that's very helpful. Thank you. Thanks for taking my questions.
Thank you.
Thank you. The next question is from the line of Arjun Gaikwad, who is an individual investor. Please go ahead.
Hello. I wanted to ask, given the Cantabil's extensive product portfolio across apparel, accessories, and footwear, does the management have any plans to open larger format stores similar to in scale of some of the leading value retail brands to create a one-stop shopping destination where a customer can access the entire range under one roof?
Yes, we are opening bigger stores, like we are opening stores to the size of 3,000 square feet also, and they have all the formats, men's, ladies, kids and footwear. So, but we are choosy about opening it because the bigger stores carry bigger risk also. So the places where we are very sure about the sales, we are opening at that places only, the bigger stores.
Extending this answer from Deepak ji, there is a difference. Let me clarify it. The value store is having different. We are not value in the category of value store. We are positioning ourselves as a mid-premium segment where ASP is approximately 1,050. We are operating 500. So the portfolio and the audience is different.
Yes, the audience is different. I was just saying that we have many products. So if I go to one store, then men's formal wear, then casual wear, women's formal, casual, everything under one store. So it's that type of I was asking. Yeah.
Absolutely.
Thank you, sir.
Thank you, sir.
Thank you. The next question is from the line of Chandragupta, who is an individual investor.
Yeah, thank you for giving me the opportunity again. So my question is, in all these lease agreements that you are signing, I presume they would all be like 10-year or 15-year agreements for lease. So is there an exit clause in this agreement? Like if you feel after a couple of years or so that that location is not so good, then do you have an exit from that?
So yes, in most of the agreements there is an exit option. Company can terminate the agreement any time after giving 3 months notice. So in few agreements there is a 1-year locking that company can't terminate within first year of the start of the store. So but most of the agreements after 1 year there is 3 months notice we can terminate.
Okay. Thanks a lot. That's all from my side. Yeah.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. Ladies and gentlemen, as there are no further questions, I would now like to hand the conference over to Mr. Deepak for closing comments.
To conclude, H1 FY26 has established a solid foundation for sustained growth. Our results highlight the enduring strength of the Cantabil brand, disciplined execution, and rising consumer confidence. We remain focused on Vision 2027, that is driving scale, efficiency, and long-term value creation for all stakeholders. We thank you all for your time today and for your continued trust and support in Cantabil Retail India Limited. We look forward to engaging with you in the coming quarters as we continue our journey of growth, innovation, and leadership. We hope we have been able to answer your queries. Please feel free to reach out to our CFO or IR team for any clarifications or feedback. Thank you all.
On behalf of Cantabil Retail India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.